Good afternoon, everyone. My name is Siddharth Singh, and I'm the head of products for Baroda BNP Paribas Mutual Fund. August has been a relatively volatile month for the equity markets, and we hope to have a solution which tends to be tailor-made probably for these markets. So, welcome to the live session on Fruitful Investing Strategies for Long-Term Success, hosted by Baroda BNP Paribas Mutual Fund. In this session, we will be talking about investing in growing, less volatile companies that also tend to share the fruits of their success, that is, dividends with their investors. Picking companies based on their on their dividend-paying characteristics is probably as old as investing in listed equity. Funds with the dividend yield strategy have outperformed the broader market index on a 3 and a 5-year time horizon. Today, we would be discussing why it makes investment sense to use the dividend-paying track records of companies to build a portfolio of potentially lower volatile and growth companies. We have with us Shiv Chanani, Senior Fund Manager of Baroda BNP Paribas Mutual Fund. Shiv has more than 25 years of experience in investing and tracking Indian equity markets. He has an MBA from IIM Bangalore. He manages our mid-cap, small-cap, value, and India consumption funds. He is also the fund manager for the Baroda BNP Paribas Dividend Yield Fund, the NFO of the fund closing on September 5th. Good afternoon, Shiv, and welcome to the live session.
Good afternoon, Siddharth.
Thank you. So let's begin with the basic question. What do we mean by a dividend yield strategy? And why should we look at it in the current market environment?
Right. So thanks for having me here, Siddharth. And see, when we talk about dividend yield strategy, actually it's one of the simplest strategy from an investment point of view. Very simplistically put, what it means is that the fund or the portfolio will be consisting of companies which are paying dividends. And I think the key word here, and something that investors should also appreciate, is that the key word is actually dividend and not so much as the yield. And we will chat during the course as to why that is so. But the whole focus is to identify companies which are paying consistent dividends over a period of time. And the second part of your question being why now, or why should we look at it in the current context? And I think you started off saying that the current month have been volatile, right? And I think this is something that we are seeing more and more so in the current time frame, particularly given the fact that what we are talking about is that globally, if you look at it, the interest rate regime is changing. We are on the verge of the rate cut cycles globally. And, it's to be expected that when such transitions take place, there is going to be a reshuffling across globe, across markets, and across asset classes. Now that is naturally going to lead to higher volatility. So the whole idea is that in the context of such volatility, can we have a product which provides relatively stable experience for the investors, right? And that can be had from focusing on companies or having a portfolio which is be investing in the companies which are paying consistent dividends, right? And so that's the whole idea that one should consider this kind of a product at this point of time, because this is a typically kind of a product which is going to be far more stable in the volatile times.
Okay. So dividends, I think, even though relatively low in the Indian context, I mean, we have dividend index yields of about 1.5, 1.25%, can still have a significant impact on the portfolio returns. The dividend yield index, for example, has outperformed the broader market in recent times. So can you throw some light on the contribution of dividends to the overall portfolio returns? How much, what quantum, and how do they impact the overall portfolio returns that an investor gets?
So that's a very interesting question, Siddharth, because of the very fact that in India, we all talk about growth, correct? we are all enamored with growth, and rightly so, because India is a growth market. Finally, it's an emerging market, it's a growth market, right? So it's absolutely correct to be focusing on the growth and hence price appreciation. So when one invests in the stocks or any equity fund in India, obviously what one is looking for is a appreciation in price rather than focusing on that dividend or the dividend yield what can come through. But just to put things in the context, uh, if you look at the CAGR of the NSE 500 index, and if you compare it with the NSE 500 index TRI, the total return index, and the difference between the two is explained by the dividend paid out by the companies. That difference is somewhere around 1.5 to 1.7% over a period of 24 years. Now, obviously, people will say 1.7%, what's the big deal about it? We are talking about 15% CAGR returns over a period of time. So why at all I should be bothered about it? But here comes the power of compounding. So a very simple data point, what our research has shown is that rupees 1 lakh invested in just the NSE 500 index without dividends over 24 years has gone to something like 18 lakhs. But the same 1 lakh rupees invested in the NSE 500 TRI, which is the total return index, has gone to 26 lakhs over the 24 years. Right? So the difference is that 1.7%, but that 1.7% compounded over a period of time has equated to 8 lakh rupees, or actually 40% higher returns than the just NSE 500 index. So now you can think about that why dividend is an important part of the overall returns that the investor has, particularly because we are talking about long term, the compounding power, and things like that. So, I think one of the key points that investors never underestimate the power of compounding and the impact of dividends that it can have on the total returns.
I think that's a very interesting point. Almost more than 40% returns come out of dividends, or probably a third of the returns come out of dividends. I think that's a good indicator of, as you rightly pointed out, the power of compounding, as well as marginal differences in the long run making a huge impact. So I think that brings me to my next question, more on the strategy part of it. Isn't it a fact that companies with a consistent and in many cases growing dividend uh, is a proxy for high quality companies that tend to provide both price growth as well as dividends?
So, Siddharth, you are absolutely right. And I think this is the reason why I mentioned in the earlier stage that the key point is about the dividend and the consistent dividend payouts. So, again, we have done research and analysis on this, on the NSE 500 companies. And what we find is that there is a very, very clear and direct correlation between the companies paying dividends, the frequency of their payment of dividends, or the consistency of the dividend payout, and the free cash flow generation of the companies. So, naturally, the companies which are paying out more consistent dividend over the last 10 years are the companies which are also generating healthy free cash flows over a period of time. And again, I go back to the same point that as an investor, finally, what we are looking for growth, but we have to understand that finally, what is the source of that growth? How do a company grow consistently over a period of time? Now, there are only three sources of growth for the company, because the company needs capital, right? To keep growing, you need capital. And there are only three sources of capital. One is equity, second is debt, and the third is internal generation. Now, equity and debt have their own limitations, right? One cannot go to the market every 2 years to raise the money until unless you are a financial institution. That also, beyond a point, there is a limitation on that. Debt, of course, there is a limitation because there is a point around debt equity and how much leverage you have. So you can't leverage beyond a point. Hence, if a company has to consistently grow over a period of time, internal cash flow generation is a paramount and an essential requirement to have. But the key thing is, as an investor, how does one get confidence on that, right? So, like an old adage goes, that top line is vanity, bottom line is sanity, and cash is reality, right? So dividends, what comes to the hands of the shareholders is the actual cash or the reality, right? And when a company has a proven track record of a long time about dividend payment, and of course we can figure out the free cash flows, like I said, there is a direct correlation. That is generally a very good indicator to say that, okay, this is a company which is capable of generating those free cash flows, and hence it can keep growing over the next 5, 10 years on a consistent basis over a period of time. So I think that's where, the whole point about dividend and free cash flow generation and the growth, the whole equation, that's how it comes together.
Great. So dividend obviously is a indicator of cash being generated in the company because cash does get paid out of dividends, and so therefore cash is the ultimate reality at the end of the day. So thanks for that. Now, Shiv, there is a myth that dividend-paying companies are not growing companies, coming from the fact that they are paying out cash to investors instead of reinvesting them in their businesses for future growth. So they don't have any growth opportunities left, so therefore they're paying out dividends. How true, if at all, is this belief, and specifically more in the Indian context?
Again, I think that's a very interesting point, Siddharth, and I think it's absolutely correct that it's a common perception people have that they are paying out dividends because they don't have growth opportunities. But I think this is not true at all. And historically, we have seen companies paying out dividends over last 20, 30 years time frame, and still they have grown manifold, from where they were, let's say 20, 25 years ago. So one is, the past experience itself shows us that it is not true. The second, on a more fundamental basis, what we need to understand is that companies have various stakeholders. Within shareholders also there are various sections of shareholders, and there can be a section of shareholders which are actually dependent on dividend as a source of income. So it becomes important from that point of view also. The third point, which is very important, is that purely from a capital allocation point of view, if you look at it, you know typically you will not want your company to be completely debt free over a long period of time, because finally the cost of equity is higher than cost of debt, right? So when we think about from a cost of capital equation point of view, it does make sense for the company to have a debt which is at a reasonable level. And of course, that reasonable level is a function of what industry, what segment, what stage of growth, what stage of market, all those kind of different variables. But purely from a financial point of view, from an ROE perspective, it makes sense for companies to have a good allocation across debt and equity. And again, when we talk about stock returns, like I said, we are all enamored with growth as a metrics, but historically it's been proven, and not just in India, but globally also, that actually the highest correlation of stock performance comes along with the change in ROEs. So companies which are delivering a higher ROE are the companies which tend to outperform compared to companies which are delivering a reducing ROEs. So, in that sense, dividend payment also helps because it, helps to increase your overall ROEs in the business. So I think it's a complete myth, like you said, that companies which are giving out dividends or paying out dividends are no growth or low growth companies. Certainly, that's not a fact. And I think it's just a matter of efficient capital allocation.
Great. So, having understood the philosophy behind the dividend yield strategy, I think let's come to some of the specifics about the fund that we've launched. So, how do you see yourself going about implementing the dividend yield strategy for the proposed Baroda BNP Paribas dividend yield fund?
Yeah. So again, I think it's an important aspect as to what investors should expect out of this particular fund from Baroda BNP Paribas. So like you said earlier that the whole equation between dividend payment and growth, and like we established that the dividend paying companies are not necessarily low growth or slow growth companies. So the focus of the fund is still going to be pretty much on growth and growth oriented companies. But why look at dividend yield is because we discussed that dividend is a good criteria, a good, sort of a shortlisting factor when we think about a company's ability to grow consistently over a long period of time. So, from our point of view, what we are looking at is not necessarily saying that, look, I will sort the companies from the highest dividend paying yield to the lowest yield, and we'll just take whatever the top 40, 50 highest dividend yield companies. That's not the idea. The idea is to use the consistent dividend payout as a criteria to shortlist the companies, and within that shortlist is then we apply the usual metrics that we apply from a growth and valuation perspective, and the entire, the risk return part of the equation. And that's how you build a portfolio of, maybe 50 to 60 companies, which is going to promise a consistent sort of a performance over a period of time. And at the same time, like what we discussed in the beginning of the call, that try to see that the volatility of the overall portfolio is at least somewhat lower than the overall market, which will eventually provide a stable portfolio and hopefully a better experience for the investors.
Great. I think that's an important point, Shiv, about we are not looking for the highest dividend paying companies or dividend yielding companies, but we're looking at companies which have a consistent, regular track record of paying dividends, and then using that as a criterion or as a indicator for the financials and the fundamental strength of the company. So I think that is a nuance, but an important nuance that you have introduced into the fund. Thanks for that. Now, I mean, as you also talked about volatility here, it is said that dividend yield strategies do tend to be less volatile and therefore lower risk. And I think you have alluded to that, but can you explain it to us in a little more detail? How and why are they potentially less volatile than, for example, a broad diversified equity strategy? And I think following from that also, how should an investor consider investing in this fund? Basically, where does this fit into the investor's portfolio?
Again, I think that's very interesting point, Siddharth. I mean, and the whole probably question is around that how is it different from, let's say, any other diversified fund, and where does it kind of fit into the portfolio of an investor? So on your first question around, how is it different from any other diversified fund? So as I said, the key metrics is obviously that we are looking to provide lower volatility in the fund. So basically, the way to think about it is the better risk adjusted returns. Now, it's a very important point to understand the risk adjusted returns concept, right? So theoretically, we can say that a GSEC is the best asset, right? Because it has zero risk. But at the same time, you are sacrificing returns. You are probably going to earn whatever 6, 7%, whatever are the GSEC yields, right? But the idea here is not to sacrifice those absolute returns just to seek that better risk return ratio, right? So the idea is to have returns which are probably in line with any other diversified funds, but at the same time have a risk which is somewhat lower than those diversified funds. And the second question is, where does it fit into the overall scheme of investors' portfolio? So again, I think in India, by default, all the investors will have portfolios which are geared towards the growth funds, right? And of course, some of them will also have some exposure to, let's say, sector specific funds. So if you think from a the risk matrix perspective or the risk spectrum perspective, where it fits in is somewhere, let's say, between a large cap fund and a diversified fund which is across cap curves. So it's probably somewhere in between that. So investor should look at it as saying that, look, I have all the funds which are high growth, everything, but at the end of the day, I need some kind of a shock absorber as well, right? I mean, to finally run a car, you do need shock absorbers because you will keep getting potholes, particularly in a country like India. Similarly, in your journey to wealth creation, you will have volatile times like what we discussed in the beginning, right? So, in such a scenario, you should have certain shock absorbers, but at the same time, it should also, uh, help you reach your ultimate destination, right? Which is the wealth creation. So, it shouldn't sacrifice on that objective, but at the same time, help you absorb those volatilities in uncertain times. That I would say that that's how the investor should be looking at it.
Great. I think you did talk about absorbers, and I think that is an important characteristic that people do talk about when investing in to the dividend yield strategy. About, I mean, if you could explain a little on how does the dividend yield act as a shock absorber to price uh, prices going down or prices being a lot more volatile than they would be for, say, other stocks.
Yeah. So absolutely. Think about you know a bamboo tree versus an apple tree kind of analogy, right? And a bamboo tree is basically, it doesn't do anything for maybe initial 5 6 years, and then you have a sudden growth spurt in that particular tree. And an apple tree is something which will give you fruits pretty much, let's say, every year after year. Correct? So, in between, let's say, if there is any kind of a natural calamity that takes place, it's likelihood that the bamboo tree will completely be wiped out, and you really don't get anything out of it. But an apple tree is probably, you would have some fruits in the past, and maybe it will sort of come back after 1 year or 2 year kind of a time frame again. It will start to bear fruits. So I think that's exactly how a dividend yield also, or companies with dividend yield also work, that it will pay out dividends and it will work and flourish in the time of growth. But in the time of volatility, what will happen is that, you know, let's say if a company has, because of the correction, it falls to maybe a 4%, 5% dividend yield. Those are the levels or whatever, at certain level of dividend yield, that starts to form a natural bottom for the stock. Beyond which, it becomes far more attractive from an investor's perspective. And that's what creates a sort of a safety net from a stock price perspective. Whereas companies which are not paying dividend, as I said, yeah, most likely they are the companies which will probably have a volatile free cash flows. And during those volatile times, clearly the free cash flows will come under even more stress. And at that point of time, the corrections in those can be far higher than probably what you will have in companies with a more consistent free cash flows.
Great. I think we'll move to some viewer questions. I think one of the questions is on diversification in the portfolio. So I think that one is around number of companies that we expect to hold in the portfolio. And two, if you could also talk about how do we go about, I mean, the composition market cap wise. I think you alluded to it a little earlier, but I mean, if you could be a little more elaborate on that.
No, I am glad that that question came up. So first of all, in terms of the number of stocks, it will typically be around 50 to 60, a diversified portfolio. But more importantly, around the cap curve, and probably I will also add flavor around the sector. So Siddharth, you talked about one of the myths that the company is paying out dividend no growth. So we established that, why that's not the case. But there are a couple of other myths as well when we, talk about dividend, investing in companies with dividend yield or dividend paying companies, is that number one, that, okay, this is mostly going to be only large cap companies because they are the companies which pay out dividend. Small cap or mid cap companies don't pay dividends at all. And the second myth is around that, okay, like there are specific sectors or specific section of companies which pay out dividend, and, other companies don't pay out that dividend, or capital intensive companies don't pay out dividend, those kind of. So, these are all perceptions people have. But, now we have enough experience and data and, reality of the last 20, 25, 30 years of history. And we can see that both are far removed from reality. Companies of all shape and sizes pay out dividends. So you have mid cap and small cap companies also paying dividends. So it's not that only the large cap companies are paying dividends. And at the same time, even capital heavy sectors do pay out dividends. So, think about life insurance as a sector. Even life insurance companies pay dividends. The capital goods companies, they also pay dividend, right? In fact, if you look at a lot of MNC capital goods companies, they are all net cash companies in today's time. So I think, what the portfolio is going to be a completely diversified portfolio across sectors, as well as it is going to be a flexi cap portfolio. So you will have a very healthy mix of large cap, mid cap, and small caps. And of course, it is going to be a dynamic allocation across cap curves, depending on the market conditions which are prevailing at a particular point of time.
And I think that's well put. So it's about 50 to 60 stocks portfolio across the market cap, and well diversified across sectors and themes is what we would be looking at in the portfolio. Just to summarize, I think what you were saying. So another question that we have is more on now the more widely known investment styles are our growth and value strategies. So uh, is how different is this from growth and value as it is commonly understood, growth and value strategies, or is a different yield strategy different? Is it completely different? Are there any overlaps, or is it say growth with dividend or dividend with growth or something like that?
Yeah.
Your thoughts?
So again, I think it's a very interesting and a long-standing debate about growth versus value. Okay, and at least the way we look at it is that there is no growth or value, right? Uh, India is finally a growth market. Correct. And like we are probably repeating it for the third or fourth time, that everybody invests in India from a growth point of view. So I really don't think that, there is a place for India to say that value in the global context that we understand. Correct. So I think in India, growth is something that is not to be compromised upon. It's a hygiene factor in that sense. Okay. And I think it's true of any fund. And I think that is going to be true of the dividend yield fund also, where we earlier mentioned as well that, uh, growth is not something to be compromised on. And like I said earlier, that dividend payment is going to be a selection criteria, selection criteria from an overall set of stocks. It's not that it is going to be the only criteria when we are building the portfolio. Finally, the portfolio will be built upon the usual factors like uh, the growth prospects and the entire equation about the valuations and the risks which are there from an individual stock perspective. So, once again, I think it's not an either or. India is always a this and that country in whatever we talk about. So even in stocks, it's about growth and value and not growth or value.
I think that's a good point. I think it is a combination, and it will be a combination. So the approach may be dividend yield, but it will be a combination of both growth and value, along with dividend being one of the indicators or the initial filters for portfolios stock selections. So I think that brings us to the end of this chat, Shiv. We don't have any more audience questions. So I would take this opportunity to thank everyone for joining us for today's seminar. And thank you, Shiv, for taking us through the dividend yield strategy with such clarity and detail. Please remember that we are in the midst of the new fund offer, the NFO for the Baroda BNP Paribas Dividend Yield Fund. The NFO closes on the 5th of September. Thank you, everyone, for joining. Happy investing.
Thanks, Siddharth. Thanks, everyone.